23andMe, as we've discussed before, has really struggled with their business model. It's actually really not that much money. It's a great deal. And if you're thinking about the amount of data that they have, it's not that much to pay for each individual data set.
But also shows that pharma companies are really viewing these digital health, consumer health businesses as an interesting platform for distribution and is starting to do these direct deals. We haven't seen a lot of IPOs, so this is really a moment where things are starting to look a little bit more promising. People are joking that they're going to rush to immediately buy shares in both these companies because their performance will dictate how the rest of the industry will essentially perform in the next few years.
This is Second Opinion. I'm Christina Farr.
I'm Ash the News. And I'm Luba Greenwood.
Welcome to the pod, where each week we navigate what's really going on in healthcare through strikingly candid conversations with the entrepreneurs and investors leading the charge.
Thanks for joining us. Let's dive in.
Hey guys, welcome to the Second Opinion podcast. We are doing a very special news format this week because so much is going on in the world of healthcare. And I've got my co-host Luba Greenwood with me. We're going to start out with talking about biopharma, biotech, big news of the moment. And then we're going to flip it over to digital health, discussing everything from the Regeneron acquisition of 23andMe all the way through to these two big IPOs. And then we'll try to cover hims and hers and the billion more that this company just raised as well. So a lot of news here today, Luba. I feel like I'm still digesting the headlines and trying to keep up. And I'm so curious your take on this 23andMe acquisition because you and I have been texting about it and you had some really great thoughts. And so we said, let's just jump on a pod and talk about it.
Yeah, absolutely. So great news, I would say, for both parties. Listen, 23andMe, as we've discussed before also on this pod, has really struggled with their business model and they're going into bankruptcy. So, there are a lot of questions and worries, by the way, from consumers of what's going to happen to their data, what's going to happen to the company. And the question is, why hasn't this business model worked? And what's the best exit opportunity for them? One of the things and one of the reasons that they have really struggled is because they were trying to do two things. They tried to have, and they did have, a very good consumer business, direct-to-consumer business, and that was great. They had quite a bit of growth, although that really slowed down because anytime that you're selling something where it's just you're selling one thing and to one customer, and those customers do not come back, they should have probably anticipated that there was going to be an issue with growth. And they did anticipate that. And that's one of the reasons why they poured so much money into research and development. One of the things is I believe about 5 years ago, they entered into an agreement with GSK, which is a big pharma company, to work together to develop drugs. Now, even though they've received quite some money from GSK for that, they had to pour in and find a lot of their own money in order to run research and development for drug discovery themselves. And I would say that's probably one of the reasons it got them into trouble in the first place, is because they didn't realize how expensive it is, how slow it is. And they haven't also appreciated that it's not exactly, I would say, it's not exactly the best fit, or as we say, synergistic with their current business, which was consumer business. So they were already on the path. The good news for Regeneron is they were on the path and they understand the concept of R&D and all that it takes. So having this partnership, an acquisition by Regeneron and being under the Regeneron umbrella, they're in a much better position to really focus their R&D efforts into the areas that are important to Regeneron. And for Regeneron, it's nice to have access to that data.
So, okay, one of the things that listeners may not know is that you used to do corporate development. You were literally in the job of being in biotech and buying companies. So tell me a little bit more about Regeneron as somebody who's worked at companies like Roche and others. What's their reputation in the biotech world? Do they do acquisitions a lot? And I'm curious, if you were on that corporate development team, how do you sort of make the maths work around this $256 million price tag for a company that essentially is heading straight into bankruptcy? Would love to hear your thoughts on that.
Yeah, absolutely. So it's actually really not that much money. It's a great deal. And if you're thinking about especially the amount of data that they have, it's not that much to pay for each individual data set. Of course, we understand that they understand that, and this is the big risk, I would imagine, when they reviewed this for acquisition, is that customers can't take their data and wipe it. So that's something that they do have to probably be careful about. And I'm sure during their due diligence process, they were thinking about that risk. And if I were them, they probably, assume that you're going to have to take about 20% of it's going to be 20% less data at the end, because that's a good number to assume that that's the number of customers that are going to delete their data. And when you're thinking about these types of acquisitions, you think about what is in your pipeline and how well you're doing commercially. Regeneron, as many other big pharma companies, are right now facing a patent cliff. So that means that they have some great assets that they're selling, some great drugs that are blockbuster drugs that are on the market, but they're nearing the end of their exclusivity. So their patents and exclusivity on the market is about to run out. So that means that they have to come up with new drugs and potentially new blockbuster drugs. Now, usually the way you do it is through acquisition of phase 2, phase 3 ready assets. The markets are so bad today that you can cherry pick, and world is your oyster for potential acquisitions of phase 2, phase 3 ready assets. If I were Regeneron, I probably would focus on those, because that's the fastest and best way to fill out your pipeline, at least near term, to fill in some of those gaps of patent cliff that they're about to face. That said, however, of course, you still, in order to maintain your strength on the market, you want to have your own internally developed drugs in your own pipeline that is even earlier. So you want to discover new targets, you want to discover new drugs, you want to be a leader in, I would say, early drug discovery and development. So that means before you enter the clinic, and then get some really exciting new drugs into the clinic, so into phase 1. And this type of acquisition allows you to do that without spending all that much money. Another thing is, just quickly on the way that you do valuation for BD, you're not just thinking about cash. Okay, you're spending that cash and it's going to go, and what is the value of the business? Of course, the value of the business, how much cash does the business have? What is the potential for making, additional revenue for your business? So that's how they would evaluate the consumer business. But for a lot of the drug development business, for these digital companies that pharma acquires, they think of what's called synergistic value. So that valuation of 23andMe provided, at least in their mind, quite a bit of synergistic value for drug discovery and development.
Yeah, I mean, I was just trying to do the quick mental maths, and I could be totally wrong, so you have to tell me if I am. But, imagine that 23andMe has about 15 million people's information, which is what's been reported, that they have about that much globally. And the acquisition price was 256 million. So if you imagine it's really about the data, then, that's like $20 per person's information, if you assume some kind of discount for all the people wiping the DNA information off the database. So that's not a bad deal, considering that most of us paid $200 to, get this information from 23andMe. So they've gotten quite a bit of a discount, even though that does sound like. And from your perspective, is that like a, pretty decent price for an individual's genotypic information?
It's a good question. I would think that they're thinking about it not so much as the price that you're paying for. I know that that's how it's reported. Like, people like to put numbers like that on. Oh, you're paying $20 for this particular information data point. First of all, just generally, if you're looking into marketplaces for how much you're paying for genetic information on anonymized way, that's actually quite cheap, comparatively speaking. But that also, the question is what type of information you're getting. So a lot of the times, yes, $20 seems not that much, but as an example, sometimes you can get access to information of genomic information, plus your labs, plus your EMR information that's linked to each individual profile.
And this isn't that. And plus, it's a bunch of white people. Like, let's be real. It's like a bunch of white people who could afford to spend $200 on a test that for the most part isn't going to tell you that much. Maybe, beyond your ancestry and a little bit of health history. And that's been a problem that 23andMe has acknowledged publicly in the past. So maybe that's part of what was kind of, the discount in Regeneron's mind. And then the other thing that I think is interesting is this relationship that Regeneron has had with Geisinger, the health system, since really, the past decade. And I was just reading about this in the morning to prepare for this. And I feel like this could be part of it as well, that they are already working with this big health system to, what they describe in a press release, collaborate on a partnership to map genetic variation. And the partnership is called Discover EHR. So it sounds like there is an integration, just as you described, with the medical record, as well as likely labs and other kinds of information that a health system would have access to. So I wonder if that's all going to get, if you think about 23andMe, Geisinger, the existing partnership, I could see this all coming together in a really interesting way.
Absolutely. So we all know that that type of information, if you're able to combine it, it's quite difficult to truly do that in a scientifically meaningful way, especially for drug discovery. Much easier for more drug development, or, for example, to find patients that match to the right trials, or even for the commercial organization to have access to that type of data. But usually for drug discovery, which is, if you read the press releases, I'm a little more skeptical, in the ability to have this type of a database and even combining those databases for the purposes of discovering new targets. So we'll see if they're truly able to do that. You may, but it's not so obvious that it will lead to new target discovery right away.
Okay, that's been super helpful, Luba. It seemed like a big price tag to me. After talking to you, I'm kind of realizing they got a deal on it. So totally reframe that one in my mind.
Hey everyone, we'll get right back to the conversation after a word from our sponsors.
Today, I'm excited to share a true scientific breakthrough for your long-term health. C15, the first essential fatty acid discovered in 90 years, and it's 3 times better, broader, and safer than omega-3. Dr. Stephanie Van Watson discovered C15 while working with the US Navy to improve the health of aging dolphins. Here's why this matters. Many of us are deficient in C15, resulting in weaker cells that make less energy and quit working earlier than they should. This makes us age faster, sleep poorly, and feel sluggish. C15 is a science-backed, vegan-friendly supplement with pure C15 as its only ingredient. It strengthens your cells, improves mitochondrial function, and protects against damaging free radicals, supporting better metabolic, heart, and liver health, plus deeper sleep and healthier hair, skin, and nails. Unlike fish oil supplements that often go bad, Fatty 15 naturally protects against oxidation. It even comes in a beautiful reusable glass and bamboo jar with eco-friendly refills. Ready to restore your long-term health? Get 15% off your 90-day subscription starter kit at fatty15.com/second-opinion using code second-opinion at checkout. Let's talk a little bit about Hims and Hers, because this company just raised another $1 billion, a company that most of us associate with things like hair loss and erectile dysfunction, but they've been getting into the GLP-1 game. And this comes after we hear about this partnership with Novo for an obesity drug that has been selling extremely well. And it's not a compounded drug, it's Wegovy. So, big part of what is boosting this company's success, both monetarily and in the eyes of investors, seems to be really related to GLP-1s. And I thought this was really interesting, Luba, both because it's a total kind of revamp in my mind of what this company is and could be, but also shows that pharma companies are really viewing these digital health, consumer health businesses as an interesting platform for distribution and is starting to do these direct deals. What do you make of that? Do you think we'll see more of it going forward?
Yeah, it's a great question. I would say we definitely will see it more. However, there are not that many drugs that would fit into that category. So here, GLP-1s, there's such tough competition right now. And Novo, as we all know, they were the first to market. They have done really well. And if you're thinking about how you're usually judged by the market on how well you're doing, it's not even how much you sell, but what is your growth, and also how much you sell compared to your competitor. So Eli Lilly certainly has done a phenomenal job also partnering with pharmacies in their distribution and in their sales. And so now that Novo is slipping in sales and growth and competition compared to its competitors, it has to find other ways to compete. So it's a bit of an outlier situation. I'm not sure if Sanofi, as an example, will go and do the same with Dupixent. Dupixent it's one of its top selling drugs. And because, again, there isn't also as much competition, and there isn't as much demand from highly educated and informed consumers that are dying to get access to this drug. So GLP-1 is a little bit of an outlier. The competitors, people like Eli Lilly or companies like Eli Lilly and Novo, of course, had to come up with novel ways. Also, another thing that happened is, and what helped in getting to this deal is that we had shortages initially last year. And as a result of shortages, compounding pharmacies were allowed to make these drugs for patients. And so patients went directly to those pharmacies and had access to basically not Novo and not Eli Lilly made drugs. And so there was already, I would say, that behavior that is accepted in the GLP-1 community for both physicians and for patients, that it's a much easier sell. Again, I'm a little skeptical of whether or not that means it will open up this type of a distribution channel for all other drugs that pharma make.
And just so you all know, it looks like the price for this new Wegovy offering on Hims and Hers is $549 per month for about 6 months. So it's a little bit less than what you could get at just, you're walking into a retail pharmacy and paying cash. Super interesting stuff.
And if I may, just one more comment, we should really get together and talk about all the recent changes in the FDA and HHS and the regulatory environment and pricing environment and how it's affecting biotech. But one of the things, as I mentioned, the GLP-1 story with Hims and Hers, I don't think is going to encourage the use of this distribution channel for other drugs that pharma makes. But what might encourage it is the changes right now on pricing and the pricing pressure that is put currently by this administration on pharma companies. And as we know, nobody likes the middleman and everybody's trying to get rid of them. So pharma companies are looking for more novel ways because of the pricing pressure and avoiding the middleman to see if they can have more direct distribution, access to more direct distribution channels that will lower the price.
No doubt an opportunity for companies like Amazon and Walmart, which brings us nicely into digital health. So 2 big IPOs that we should talk about, Luba.
Yeah, tell me about it. Tell us about the IPO market for those. I was surprised because I can tell you IPO market is pretty much closed for biotech. So it was a nice surprise to see digital health companies out there in the space.
Yeah, the first one I think I'll talk about is Hinge, because I've been writing a lot about this one. The last private valuation of this company was around $6 billion, and they're going public at under 3. So, from that perspective, if you're a growth stage, late stage investor, you did not do well. But a lot of the employees did well, and the founders did well. And I think for all intents and purposes, it was a decent revenue multiple. I think investors were willing to believe that there is an AI potential for this business. Just to refresh your memory, in case you haven't come across Hinge recently, what they do is they sell PT to health plans, employers, and it's mostly virtual, and they've been increasingly doing it with AI. And the idea is that there are a subsection of people who do not need surgery, should not be getting back surgeries and whatnot, and that if they were to do PT, they could avoid it. And it's a tens of thousands of dollars potential savings for an employer. So they've sold to a lot of jumbo employers. They're starting to think what else is out there with the opportunity in Medicare, in health plans, the fully insured market. And that's kind of the big thing that's up ahead as they go public, as well as just continuing with this AI push that they've been making. Meanwhile, Omada, we don't know yet. They just filed the S1, which I've been kind of pouring through over the past couple of weeks. I don't see this business as getting quite the revenue multiple that Hinge got. Omada's in the area of kind of chronic disease, cardiovascular disease. Behavior change is extremely challenging. And I do see some opportunities to use AI with this business, but I think Wall Street is going to be a little bit more skeptical, particularly given that, that the patient in this case is a person with prediabetes or type 2 diabetes or hypertension. So I could see that one maybe in the sort of $700 to $1 billion range, but we'll see. And I think the question there as well is, where else can they expand outside of the employer? So very interesting to see two companies both selling to employer, both going out at around the same time, and both kind of facing this uncertain future of how do they expand beyond this kind of core market that they've really built up a dominant position in.
And do you think that, again, there are recent changes in administration and more of a focus on prevention and intervention with not using therapeutics? Do you think Hinge is even in a better position potentially for revenue growth and getting into Medicare Advantage markets than anticipated before?
Yeah, I'm not sure that the administration is going to have that much impact. I think that the question is going to be the team. What kind of team can they hire to really take advantage of this opportunity? I think that's the big challenge for digital health companies is you hire a team to sell into one area, which is employers. And then if you want to expand, it's not easy. You don't just get to say, okay, today we've woken up this morning and now we're getting into Medicare. It's a very different sale. And you need a totally different team to execute on that. And sometimes these kinds of pivots can be more challenging when you're a public company. So I think that's going to be my kind of question mark. And then there's, of course, the regulatory aspects of AI that I will be focusing on as well, because there are things that we can do with AI, and then there's the regulation. And those are two very different things. So, how much you have to keep a member of a care team in the loop, I think is kind of an ongoing question.
That's fantastic. Do you foresee anybody else, any other big digital health player that would come even close to considering doing an IPO in the next year?
I think there's a lot waiting on the sidelines, whether it be an Included Health, whether it be a Maven Clinic, whether it be a growth therapy, whether it be a Nourish. I mean, there are lots of companies that have over 100 million in a revenue run rate that things are looking pretty good with these companies in terms of, the fundamentals. I think the other big thing to point out is just profitability is the name of the game these days. Hinge is, for the past couple of quarters, has been solidly profitable, and I think they will get rewarded for that. Omada is not yet profitable. And a lot of digital health companies are not profitable. This is easier said than done. So, the whole industry is watching Luba. People are joking that they're going to rush to immediately buy shares in both these companies because their performance will dictate how the rest of the industry will essentially perform in the next few years and whether or not the IPO window is open or not. We need exits in this space. And I think this is one of the most important moments that we've had in a long time.
And is there exits in terms of IPO or exit in terms of being acquired after an IPO?
It's both. And I don't mean any old exit. I mean exits that return money to investors. And, we haven't seen a lot of IPOs. So this is really a moment where things are starting to look a little bit more promising. And M&A has been hard. And we should do another show on that because I have a lot of thoughts on why we haven't seen as much M&A, both from the big health plans, from the health systems, from private equity. It's been slower than I think a lot of folks expected, especially in this market where you could pick stuff up for a song. So let's do a future episode on that because it'd be fascinating to dig into it. And you've got a background in M&A, and I work with companies on the consulting side thinking about M&A and talk to buyers a lot. So we should come on and talk about the kind of biotech and digital health landscape. But I want to say thank you, Luba. This has been a great show. I love our news kind of overviews, and I can't wait for the next one.
Wonderful. Thank you. Great talking to you.
Thanks for listening, guys.
Thanks for tuning in to Second Opinion. Share it with colleagues and friends and message us to let us know what topics you want to discuss on the podcast. If you want to support the show, the best ways are to leave a review wherever you're listening and make sure you are subscribed. And check out Christina's Second Opinion newsletter on Beehive. A link to subscribe is in the episode description. Second Opinion is part of Turpentine, the podcast network behind Turpentine DC, Age of Miracles, and more shows for experts by experts in tech.